Welcome to the Remarkable Retail Podcast, Season 4, Episode 16. I'm Michael LeBlanc.
And I'm Steve Dennis.
Well, Steve, together, not necessarily together, but that will happen too. We're back on the road traveling. I was in Montreal last week at a big food innovation show, and you were traveling as well, I believe, doing store checks in the DC area, yeah?
Yeah, I took advantage of going out to visit my younger daughter who lives in the greater Boston area, and I decided to swing back through DC both to visit with a client of mine and to go running around the DC area to check out a few stores. Whether DC is the harbinger, I think that's the word, of the future of retail, maybe we can chat about that a little bit.
Yeah, I'd love to hear all about it. And we have a very special guest, Lee Bird, Chairman CEO of AtHome, which is right in your hometown of Dallas, the great state of Texas. Though they have stores across the country. I didn't know the brand, but I was so impressed as I researched the stores. And, of course, talking to Lee, who's a really impressive leader.
Lee reached out to me kind of out of the blue. I didn't know him. I was aware of the brand. He reached out to me and said, hey, would you mind going on a store check or store visit with me? And I was like, well, CEO of a retailer wants to walk around a store with me. I'm going to say yes. And he's a great guy. It was really interesting to hear more about their strategy, kind of get a behind the scenes look. And since then, I think that was 3.5 years ago at this point. Since then, they have continued to grow. And it's a really interesting story. And he's got a phenomenal background too. So I think there's some good leadership lessons there.
That's an interesting way to interact with you doing a store check. I'm actually doing a store check with one of our prior guests in a week and a half from Bunnings, all the way from Australia. Michael Schneider is going to be my guest, and we're doing another store tour. So it is a really fun, interactive way to talk to people, right? It brings strategy and thoughts to life. Yeah, I do really enjoy those.
So before we jump into the news, I just want to mention really briefly that my book, Remarkable Retail, has been chosen as a Kindle monthly deal. So I believe this is only available in the United States, but the book will be available, the Kindle ebook version will be available for only $1.99 for the month of May. So go check that out. If you haven't checked it out yet, this is your best opportunity to do so for a very little bit of money.
Very good. Very good. All that thought leadership for $1.99. Come on. That's fantastic.
But wait, there's more.
And I've got a little bit of a milestone actually today. We're recording this on Friday with one of my other podcasts, The Voice of Retail.
Yeah, I was going to ask you about that. I saw that you posted that. It's your 300th episode? Is that right?
It is my 300th episode, which is, it's a great milestone. So for anyone who happens to listen or not listen, thanks to everyone. And we appreciate so much, whether it's on Remarkable Retail or The Voice of Retail, all the other podcasts, the guests that come on and share their insights like Lee. So, great milestone for me. So,
congratulations.
Very happy. Thank you. All right, well, let's get into the store tour. I'm kind of keen to hear. I see you were tweeting a few pictures, which made me LOL, as the kids would say. So, talk about your store tour. What'd you see and where'd you go?
Well, my main intent was to see the Bloomies concept from Macy's. So this is the small store version of a Bloomingdale's store, as well as a couple of concepts from Amazon, Whole Foods, and the Amazon Fresh store. I also popped into the Tyson's Corner Mall, which maybe we'll talk about briefly. Just it made me think about a future episode we need to do. But anyway, start with the good. I really thought the Bloomies concept was very well executed. So it's in Fairfax, Virginia, which is some folks will know is a suburb of DC. It's in I guess you'd call it a lifestyle center. So it's got residential, lots of dining, all exterior, a number of well-known brands, Lululemon, Warby Parker, those sort of places, as well as West Elm, Williams-Sonoma. So quite an interesting mix of tenants, really well done. The Bloomies store, I think it's about 20,000 square feet, perhaps, so quite a bit smaller than the full-line Bloomingdale's store. And it's got a very boutique feel. The visual merchandising was excellent. Presentation was excellent. They've got a very prominent, I guess you'd call it like omni-channel fulfillment center up front. So where you can do returns, do pickup, that I thought was also very well done. There's a little cafe that's adjacent to it. So overall, in terms of its presentation, I thought it was quite good. It's a little bit hard for me to understand without getting into their data exactly who this is for. because it's a little bit of everything, it doesn't have a home section, but it's got some men's, it's got some kids, it's got some women's. It's a little bit of everything. So it's very tightly edited. I would say it's definitely edited towards a younger customer for sure. But a lot of the stuff they had in there was quite expensive. Like they had what I thought was a crazy amount of Balenciaga sneakers, which are between $800 and $1,200. And I'm kind of like, is there that many people? They also had, one of the things I think I posted on social media was a patches stand. So a little counter where you can get patches like on your jean jacket, I guess. I don't know. It was like a
is that a thing?
Patching monitor. I maybe this is what the kids are into. I don't know. But that was it felt like a little bit of an assemblage of kind of cool ideas that maybe we're in search of revenue. But anyway, I thought overall great location, well done. Whether the concept's really going to hit the market or not, I don't know. Then I headed over to the Whole Foods store in it's called the Glover Park area of Washington, D.C., if people know that. And this store has maybe 12 walkout, what would you call them, lanes, I guess. So you can use your palm, you can use your phone to just, walk out without having to do any checkout. There is one self-checkout lane, which seemed to be used the most by people. It was not a particularly busy time, but it's a really nice store.
I guess you need a bit of that. Do you need a bit of that for alcohol? Because I know you have to interact with an associate.
Well, it's interesting you mentioned that. So what I saw both with the Whole Foods store as well as the Amazon Fresh store, which we'll get to in a second, is they have a separate area that you have to walk into and show your ID to get into to get alcohol. So I assume at that point they disable, they basically ring you up so that you can go through the main checkout area. But I thought it was well signed. They've got like signage everywhere, kind of reminding you to grab, you can grab paper bags, you can grab, your own bag to bag basically as you go. So you're ready to just walk out. So I thought that was very well done. Then I went a couple miles away to the Amazon Fresh store in DC. There, I think, are 3 Amazon Fresh stores in the DC area. This is by far the smallest. So I may cut it a little bit of slack because of that. But I was very, very disappointed, I have to say. Few things. One is very uninteresting merchandising. The presentation was, I thought, very flat. So it just wasn't an interesting place to shop. It was a lot more like an Aldi, if people are familiar with that, or maybe a little bit more like a Trader Joe's.
Which is thought of like as a hard discounter, which isn't what I thought they were going for.
Yeah, it, way more basic looking and kind of boring. I thought they had a very high rate of out of stock. I mean, it was quite shocking. I have several pictures.
What day of the week were you there?
It was a Monday afternoon. So, that depending on when they get deliveries, and obviously there's supply chain.
Busy weekend.
Supply chain issues. But I didn't see any of that at Whole Foods. I went into another supermarket. I didn't experience anything like that. So that was strange. There's no self-checkout. You can only do the walkout, and the signing there was not very good. So, I know how it works, but if you didn't know how it works, it was kind of confusing. And there was no store associate nearby to help you. They seemed to be really understaffed. Just even from a loss prevention standpoint, they had nobody in the front of the store. I was in there for 15 minutes, and I saw one person kind of running around, went into the back, and then I didn't see them again. So the staffing was really odd. Bunch of dead space.
I guess from a loss prevention perspective, you'd have to, like in a subway, jump over the turnstiles, right? Because obviously if you grab something and, the whole concept is shop it like you stole it, right? You just, once you're in,
you could, you probably
jump over the turnstiles. You're
absolutely. Yeah. They're not set up to be particularly protective. So yeah, it was very odd. I'd like to think that, I caught them on a bad day, or there's something about that store, in terms of its size or layout, because it is a little bit peculiar. And it's kind of a funky location. So overall, though, that was very, very disappointing. So the last thing I'll mention is, actually I did this before I went to Bloomie's. It was the first thing I did. I went out to the Tyson's Corner Mall in Virginia, which is about 3 miles away from the Bloomie's store. And some people will know that's a huge mall, 5 anchor tenants. I think it's one of the top 20 or 25 malls in the U.S. I hadn't been there for 15 years. I opened a store there about 15 years ago. That was the last time I was there. What was interesting to me, and I don't know that I even want to tee this up without being able to get into it, but it just really struck me just like how comically large and kind of ridiculous some of these massive regional malls are. The layout is so confusing. It's so hard to know where you are. You have to walk an incredible distance to go. If you want to go between the Nordstroms and one of the other anchors or go over to the food court or whatever, it's 10 minutes. They happen to not, I'm not sure I'm forgetting now who owns and operates that mall, but they don't seem to have put a ton of money into the mall to kind of really update it. So it's not particularly interesting visually. And probably 10%, I would say, of the space was vacant. And probably another 10 to 15% were brands or concepts or whatever that I would be like, I don't know who that is. Or that just seems like a really tired old concept. So it's just, like I said, I'd like to kind of come back on the future of the malls because I think even some of the better malls are so overspaced and so uninteresting that I think, there's a good reason that for the most part, malls overall continue to lose market share, even if they're seeing a bit of a resurgence now.
I was going to ask you the question. It's interesting because if you closed your eyes and imagined 15 years ago to today and opened your eyes, was there a big difference? Or could you have been 15 years ago when you plus or minus a few retailers? So what I'm hearing is you didn't see anything remarkable or remarkably different about a format that is really in need of change.
No, and like I said, I'd like to take this on and get into more depth, but I would say overall, not very much. I mean, there's like a Peloton store there. There's some newer retailers that are there. The handful of those, there's just a Shake Shack. There wasn't a Shake Shack or whatever. But aside from a few newer retailers, it looks to me very much like malls have looked like for 15, 20 years. I'm sure they painted the thing since then or whatever. But no, so it was really, as I say in my book, I generally believe. But I'm kind of revisiting it, which is why I bring it up and why I think it might be worth talking about in a future episode. I generally believed that the really good malls were not necessarily in need of that significant a change. It was really the B, C, and D malls that are really in trouble. But I'm starting to believe that that's not as true as I once believed as I spend more time in some of these malls and really take a hard look at them. But anyway, topic for another day. But
that's a whole episode. Let's talk about that. Let's just pop into some of the news of the week. Amazon, speaking of Amazon, you're in a couple of Amazon stores there with Whole Foods and Amazon. They put out their earnings, and the general vibe was, a deceleration in sales growth. Anything else you observed from the earnings?
Well, so we're recording this on Friday morning. They reported, I guess, after the market closed last night, and it was big disappointment. They fell well short of sales and earnings expectation. Now, part of it, which is a little bit, well, there's always a little bit of confusion with Amazon earnings anyway, but they did take a big write-down of their investment in Rivian. So that explains some of the headline numbers you may see about how big the loss was. But if you actually, apparently people don't love it, or Amazon doesn't love it quite as much. But in any event, but if you look just in general at what's going on, the sales growth at the very top line was much lower than the rate, the kind of the trajectory they had been on. They reported what appeared to be, well, I shouldn't say what appeared to be, but AWS did well, but basically the rest of the business lost a lot of money. It's, as people probably know by now, Amazon doesn't do a very good job of breaking things out by segment, so you can't really tell what the impact of the advertising business was compared to Prime, compared to retail, et cetera. But given that we know, and they quoted some top line numbers about advertising, but given that we know the advertising business is massively profitable, the fact that everything else but AWS lost a ton of money suggests that retail lost a ton of money, Prime lost a ton of money, et cetera. So, there's a bunch of, and that's all led to negative free cash flow. And Amazon has been kind of a cash printing machine. So it's not a very good, and the Rivian write-down is not a cash item. So from an operating basis, they have negative cash flow pretty significantly. So this is a pretty big disappointment. Stock's down a lot. I think it speaks to two things. One is, which is very much what we tackled in the last episode, that e-commerce is really decelerating, and Amazon is 40% of e-commerce. You kind of expect that we would see those sort of numbers. I think the other part is, and they talk about just the costs. Not only the supply chain issues, labor issues, you name it, is really impacting their margin. There's some speculation that they kind of have overinvested in infrastructure, given the trajectory of sales. I think, that may explain it, but, I think we'll need a little bit more time to figure that out. But anyway, overall, very, very disappointing performance.
Well, as big as and great as Amazon is, they're not impervious to all these cost drivers, right? I mean, whether they do it themselves or something else, these things are affecting everyone. Let's say last couple of things. I'm laughing because I'm just reading your post on Meta opening a store to sell the metaverse, which you called the death of irony, which just cracked me up.
Yeah, the best way to explain the potential of metaverse is to open a physical store. So yeah, I found it very ironic, don't you think?
Thank you, Alanis.
But at the same time, great Canadian, right? At the same time, I do think it makes a lot of sense. I think for people to understand the technology and how it works, having an in-store experience to be able to try the headsets on and talk to somebody and all that kind of stuff, I think it makes a lot of sense, just much in the way that there are plenty of showrooms for all sorts of things, right, that you may eventually end up buying online once you get into it. So this particular store is actually going to be on their Burlingame campus. So I wouldn't, like we talk about with Amazon and Google opened a store, I wouldn't necessarily conclude this is suggesting some big massive store rollout.
You might see one in Soho or some.
Right. My guess is, they're going to sort of shake it down, and then they may open a handful of them. I don't think they're necessarily going to have hundreds of these, but you never know.
It's not like they lack the resources to do it, right? They can do whatever they want. They've already sunk $10 billion into this, so what's another few dollars of lease leaseholds? And again, in a kind of a funny, I don't know what to call it, but JCPenney, we talked about JCPenney a couple of episodes ago, throwing their hat in to take over Kohl's. So is this 1 + 1 = 0.5? Like, how's this going to work?
Well, sort of, I think of this as kind of, it remains to be seen. Perhaps by the time this episode comes out, a deal will be done. But the owners of JCPenney, which is Brookfield and Simon Properties and Authentic Brands Group, is kind of involved some way. So two big mall operators have thrown in a bid, apparently, to buy Kohl's. I think, in the good news category, my guess is that they would be better owners than a financial firm. They actually have strategic value. I'm sure there's, synergies, cost synergies, et cetera, that could be realized across a portfolio. On the other hand, as I think I said on social media, putting a slightly better than mediocre retailer together with a terrible retailer is not obviously a winning strategy.
It doesn't jump out to me like it doesn't jump out as in that's a win. That's a winner right there. Yeah.
Well, at the risk of being kind of glib about it, the reason that Kohl's has been stagnating and the reason that JCPenney has been tanking for 10 plus years is not because of their cost structure or getting synergies or being owned by mall operators. It's because they are not sufficiently customer relevant. So it's not clear to me what Brookfield and Simon bring to that party. So it's hard for me to get excited about this from the standpoint of, this is really going to put these two brands on a much greater trajectory, because they both have Penny's way more than Kohl's, have a lot of challenges. But, I think, when Simon and Brookfield bought JCPenney, there was a real sense that Penny's was probably going to be liquidated if that didn't happen. Mm-hmm. And so for these mall operators to have control of that, had some sort of option value, I guess you could say. Owning Kohl's, is kind of interesting because Kohl's is clearly better positioned from a real estate standpoint. So, I don't think we've heard much about what they plan to do, other than I think they said they would plan to keep them, essentially as separate brands. But anyway, we'll see. We'll see if it happens. It does seem like something is about to happen with Kohl's one way or another. But like I said, perhaps by the time this comes out, we'll know.
That's great, great roundup. We went a bit longer than our usual episode, but so much going on. Great to hear about your tour. It's so great to get out and go to different places and experience this. But now let's talk about At Home, and let's get to our interview with Lee Bird from At Home.
Well, Michael and I are delighted to welcome Lee Bird from At Home to the Remarkable Retail Podcast. Lee, thanks for joining us. How are you today?
I'm doing great. Thanks for having me today.
Well, you bet. Well, you and I have known each other for a little while, and we're really excited to have you come on the podcast. But maybe we could just start off by having you tell everybody a little bit about yourself and your professional journey, and then we'll get into learning more about what's going on at Home.
Sure. Well, I've been at Home for almost 10 years. Before At Home, I held a variety of leadership positions. Most recently, I was serving as a partner at a global private equity firm. Before that, I was a group president at Nike, chief operating officer at Gap, chief financial officer at Old Navy. And before my consumer retail career, I had various strategic and financial leadership roles at Gateway, Honeywell, and Ford Motor Company. And I began my career as a commercial loan officer in a bank in Boston.
So any brands we would have heard of, though? It doesn't sound like you've worked for any
No, probably nothing you've heard of.
No, that's too bad. But, well, we'll make do.
So, Lee, nice to meet you. Tell us about, for the listeners who may not know, we have an international audience, a little bit about At Home. Can you describe the business model, the scale and scope, where you operate, and what makes you different in a pretty busy space?
Sure. Well, At Home is a growing national home decor retailer in a warehouse format here in the U.S. We've got 247 stores in 40 states, doing a little over $2 billion in sales. We've got long-term potential to expand that footprint to at least 700 stores, growing about 10 to 15% a year. And our mission is to enable everyone to affordably make their house a home. And we offer about 45,000 on-trend home decor products to fit any budget or any style. You know, think about furniture, mirrors, rugs, art, housewares, tabletop, and anything to decorate both the home inside and outside the home.
I guess when we met, which was probably close to 4 years ago now, you were nice enough to give me a tour around one of your newer stores, or at the time was one of the newer stores in the Dallas area. And I learned quite a bit about the transformation that the business has undergone back from the days. Some of our listeners might remember a concept called Garden Ridge. So a lot has happened in, I guess, 9 or 10 years. Can you just tell us a little bit about that history and how the transformation came about and all the different things that have been going on over the past few years?
I had actually tried to buy the company a couple years before that with another private equity firm, raised the money, and the company decided not to sell at that point, took it off the market. But I was enamored with the idea of this business. It felt like it could become a national retailer. But knowing that when I joined eventually as CEO, once they had new ownership, I knew that the Garden Ridge name and history were going to be a barrier to our growth. Financially, it had a bankruptcy in its history. The customer Yelp reviews were tough. I would tell you the Glassdoor reviews weren't much better from the employees. So we focused on improving the employee experience first, then improving the overall store experience. Then we adjusted the product assortment to align with the strategy that we would become the home decor superstore. And the last thing that we did was deciding on a name change. And we hired a branding firm that I'd worked with before from New York City. And I certainly wanted to have a name that would be easy to say, that was common, that was in the common vernacular of our society. And it was clear that we were in the home business. And so I gave them that spec, and we landed on the name At Home. We then invested about $20 million in the rebranding, including changing our name color palette to gray, blue, and white. Then we tested the name. I always felt like you should test before you roll. So we tested the name in St. Louis. We rebranded all the stores in the St. Louis market. We did custom research with those customers, and 96% of them said they'd come to an At Home store as much or more as they would have when it was Garden Ridge. And 97% said they'd spend as much or more at an At Home versus Garden Ridge. So I'd call that a success. So once we knew the customers liked it, we went market by market, rebranded the whole company within about 5 months, and comps improved 8%. Same-store sales were 8% increase that year. 5 points of that 8 points was from the rebranding. So the new identity really reflected better the company's mission to enable everyone to make their house a home and to address every room, every style, and every budget. So we were really pleased with the outcome for that. And it's been really a rocket ride since then.
So, as I'm thinking about, and this comes up a lot on our podcast, what it takes for retailers to innovate. And it seems like a lot of times, and you can tell me if you agree with this or not, that plenty of retailers are able to do fairly incremental changes, but you did pretty radical transformation. Is there anything, is that just very particular to the place you found Garden Ridge at the time, or are there some underlying lessons there that other retailers might take to heart to actually, kind of aim higher, go bolder, be, more committed to a faster transformation?
Part of it was the Garden Ridge situation. Not very many companies do you walk into that had a bankruptcy in its past with bad Yelp reviews and Glassdoor reviews. So we had to do a lot to make some changes. And by changing the name, you could leave all that history behind you. I did find that the elements of the business were great. They had home decor at its very core, and we just wanted to bring that to life. And so I would say some of that's unique to Garden Ridge, but some of it's consistent with everyone. You need to make sure you've got a great business model, which it did, a strong customer value proposition, a great employee and customer experience. And if you don't have those things, you obviously need to put things in place to make it come to life that way.
So the rollout was, and maybe you said this and I missed it, the rollout of the new branding. What year was that?
2014.
Okay, so then within, I guess, just 2 or 3 years, you went public, only to then go private again last year for, I think, close to about $3 billion. Can you just talk about a little bit what transpired in your journey into the public markets and then back into the private side?
For me, it's always about having the right owner for the right time in the business. And we had a strong growth company. But I also knew, and our executive team knew, that we needed to make some nonlinear investments going forward to keep our momentum and realize our full potential of the company. As I mentioned, could be 700 stores across the U.S. And so taking the company private allows us to make those investments, invest in store expansion, invest in brand awareness, investments around the customer experience and our online presence, to realize our full potential. So going private allows you to do that more easily than a public company, and we're thrilled with the ability to do that.
Did you feel like I remember when we first met that I somewhat, and even though you guys are based in the Dallas area, I live in the Dallas area, I still felt like At Home was kind of this almost like this best kept secret in retail. You had a significant number of stores, great performance. I'm not sure quite how many states and markets you were in at that point, but I think you're in like 40 states now. So it's not like you're a tiny little retailer, but somehow didn't get maybe as much love from the public markets as they should have. Was that part of the motivation or not?
It was really about the business. Let's just make sure we've got the right owner for the business. And we needed to make some investments. It's hard to do as a public company. They don't always reward you for that. And the feeling was, let's make sure we've got the right situation for us to continue to grow and build on this great company and this great brand. And so we wanted to do that. We were able to do that, make our investors, our existing investors, a nice return for their investment. At the same time, put the company in the best position for growth going forward.
Lee, let's spend a bit of time talking about your business and the category in the COVID era, and I guess kind of in the post-COVID era. Probably, really strong demand. Supply is maybe a bit problematic. Long lead times. We hear about the supply chain challenges. Has this changed you or your team's perspective on global sourcing, where you find your product and how you find your product? And share your perspectives on that in what now is an even more turbulent supply chain challenge globally.
Yeah, it certainly has been for everyone. And I would tell you, for us, just as much as anybody, we do think about our footprint a lot. We've been growing like crazy, as I mentioned. We had same-store sales growth, high double-digit same-store sales growth 2 years in a row. So you're talking about high growth at the same time we're opening up stores. That's made us a top 30 importer, and so we do import a lot of our product. We have 100,000 square feet that we fill our stores with, and right now I'll tell you our stores are stocked right now with inventory, which not every retailer has that same blessing. So we've got the inventory that we need to run our business. That's taken a lot of work. It's taken some investment to get there. We always continue to refine our view about our sourcing footprint. We want to focus on making sure that we've got the right product partners to help us. We design, develop our product with them. We're a vertical retailer. It's all essentially private branded. Over 70% of our product is private label, private branded. And so for us, it's about the design development work and working with great product partners. And we've found that we can do that across the globe. We've been diversifying across the globe and finding even better product partners that can address new categories in improving our quality. But it hasn't been easy the past 2 years. Boy, getting the product here, the stops and starts of COVID that we're dealing with, the incremental costs to bring the product in, all of that's been a challenge. But thankfully, because of our size and scale, we've got partners that can help get our product here when we need it.
Yeah, it really is a case where scale really matters, right? In the import business, right? It's a huge, you get on that boat or you reserve that plane. Let's talk about the economic conditions. And you've been operating in multiple different economic situations. What's the playbook now here as we enter these inflationary times, and some questions about growth, even as consumers shift from buying goods to services in the post-COVID era? What's your playbook trying to understand retailing in the inflationary days?
Well, Michael, anytime you've got input costs that go up, you have to look at your cost structure and at pricing, unfortunately. And as a low price leader, we're very, very cautious about increasing prices. And we also have the best and lowest cost structure in the industry for us. So I would tell you that we need to, take a fresh look, and we always have, at our price increases. And so we were slow to take price increases, but we've had to recently. We've noticed the competition had already raised their prices because of the freight and labor cost challenges that many of us are experiencing. So we've had to look at price. We've also had to look at costs. And we think from a freight standpoint, eventually freight costs will get back in line, but we do know the labor costs are here to stay because of a labor shortage. So companies are going to continue to have to focus on being efficient, and companies like us with low cost structure will be winners.
So maybe this is maybe you can tell me whether this is a fundamental trade-off, but I understand you recently published your first corporate sustainability report. Sustainability is obviously a very hot topic in the industry. And maybe you just kind of tell us more about what you were aiming to do there, or what you are aiming to do there. But a lot of times there seems to be this trade-off between ethical sourcing and fair trade and these kinds of things, while trying to maintain that low price position. That's obviously a core part of your business model. Can you tell us a little bit more about what you're up to there and how you address those trade-offs, if you in fact see them as trade-offs?
Sure. I'd say ethical sourcing is always the right thing to do. You've got to make sure that your product is made in such a way that you're comfortable with it and that your customer will be comfortable with it. And we've always taken that lens in our product strategies and our sourcing strategies. And now, as we've moved more towards direct sourcing instead of agents, about over 20% of our product now is direct sourced. We directly source from India, Vietnam, Pakistan, Cambodia, and China. And our goal is to be a third direct source. And as you go more towards direct sourcing, you can expand the number of factories. You can really drive your own agenda in terms of what you want from a factory condition standpoint. So we are focused on that, making it not only our company a great place to work and grow, but also our product partners to be a great place to work and grow. And so we're focused on quality and leveraging those partnerships to help us achieve those outcomes while keeping costs low. And we've expanded across Europe and Mexico now too. We're getting savings from that cost and improving our speed to market. So as we look at our footprint, we make sure that it's not only ethical, but it also achieves our objectives. And we don't look at just product itself from a sustainability standpoint. We look at our whole value equation and our whole cost structure. For example, we've recycled more than 7 million square feet of retail space because we typically take second generation real estate. And that allows us to repurpose old boxes, not have to build an all new building, not have that environmental impact. And so we think about all of that, our entire footprint on the globe when we think about sustainability.
I love that. And maybe, I don't know if this was what you were getting at, but I remember when we first met, you were telling me a little bit about your real estate strategy and the sort of buildings you were going into. Is that strategy? Maybe you could just kind of give the background on that. And has that strategy largely stayed the same, or are you shifting it?
It has stayed the same. We like second generation real estate. So other retailers may have closed a large box across the country, and we've already analytically scored all 20,000 operating big boxes in the U.S. and said which ones, and then scored them as if it was an At Home. How much sales would it do? And then build a market plan and said, how do those stores fit into our market plan? So when a box comes available, we'll know, does it hit the market plan? What would be the projected sales in that location? And we can take over a big box and get in there within about 120 days from the idea to the time that we move in. So we can move fast too. So we become a great solution for landlords. And that allows you to do it at a much cheaper cost from a CapEx standpoint than having to build it all yourself.
I didn't realize you were doing things so quickly, but the JCPenney store that you occupied not too far from where I live, I felt like that got done in about 2 weeks. I'm sure it was longer than that, but one day I drove by and I was like, wow, it's an At Home. So it seems like it came out of nowhere. But the other thing I wanted to ask you about quickly was when we met, one of the things we were talking about was the role of digital. And I think at the time, you did not have much of an e-commerce presence, but it seemed like you moved quite quickly. I don't know if it was motivated by COVID or it was really pre-COVID to put together what I call, more of this harmonized retail, this blend of physical and digital. Can you tell us about your journey there and how that's been playing out?
Sure. We were super thoughtful about our digital strategy. I'd seen retailers rush to digital without understanding the implications to their business model. And we decided we were going to learn from those that had gone before us and ensure that we did it in such a way to meet the needs of our customers and our investors. So, in other words, we were going to do e-commerce our way. And we did. When I met with you, we were in that studied out process. And 2 years ago, in early 2020, we started a 28-store test on buy online, pick up in store. And as soon as COVID started, we rapidly rolled out the buy online, pick up in store to all stores. We added curbside pickup and an enhanced local delivery service to meet the needs of our customers at that point. And we did all that in less than 22 months. So we were slow to start, but then when we implemented it, we were very quick. And that taught us that we can move fast to meet the needs of our customers, and also taught us that we can work differently and operate differently. And I would tell you that thinking about how to work differently and operate differently, we all have done that in the past 2 years because of COVID. And in fact, we're actually building a new corporate campus here in Dallas, and that corporate campus will now enable hybrid working, which is also allowing us to work differently with a flexible workforce.
Again, one of the things that Michael and I have touched on a lot, talk about a little bit in my book, is why does it take a crisis for retailers to innovate? Or I guess you could say, any large organization. Do you, since you have worked at a number of other places, what have you really learned about innovation more broadly? And it sounds like a bunch of things that you learned from COVID are going to stick in your new model. But any just general comments about innovation and how to move more quickly?
Well, I think you need to be thoughtful about what the needs are of the customer first and foremost. You can't worry about other things. You always need to be relentless about the customer. And so make sure you've got the right customer value proposition right away. And if you don't, you need to make sure you address that right away. And I would tell you that it takes courage. I've always loved the phrase, fortune favors the brave. So some folks struggle with that, and you have to have courage. But I would tell you data helps inform and enable courage too. So I love it. To innovate, you need to test, you need to get good data, you need to then try things out, be willing to fail. But then once you've locked in on something that you think is going to work, then have the courage to move fast. Because when you do that, the customers will see that, they'll be excited that you're innovating, and they'll want to be a part of that as well.
Well, Lee, last question for you. It's been a great discussion, and you're talking about moving fast and aligning to the ever-moving, ever-changing consumer. What's next for At Home? Or do you have? It sounds like you're expanding your footprint for sure. New categories. Have you considered international expansion up here, perhaps to Canada? What's next on the blueprint to continue that momentum that you've established?
Yeah, I would say, just building off of that comment around innovation, I'd say what we have right now is going to enable our future. We've got a great customer value proposition, a low price leadership in home decor. We've got an amazing and very healthy business model with a low cost structure. We've got a great leadership team and a great team overall because we've hired well and developed our team. And we've got an amazing culture. When you have those pieces in place, you've got a great company and you've got a great concept for the customer. So for us, we're going to move forward and grow. We're going to gain meaningful share. We've been doing that for the past 9.5 years that I've been here, and we're going to emerge as a major winner in the home decor space. And our mission is to become the leading home decor retailer, and we'll do that by enabling everyone to make their house a home. So that's going to be our effort, and we're going to be executing our plan against that to ensure that we offer those everyday low prices to our customers by having fresh, relevant product for them, for their home, in every style, for every room, and at every budget.
All right. Well, listen, this was such a great interview. Lee, it's a treat to get to know you and get to know the business. I think it's next door to Steve, but for me, it was a new adventure getting to know the business. So congratulations on all your success, and I wish you much continued success on behalf of Steve and I. And thanks so much for joining us on the Remarkable Retail Podcast. It was a real treat to have you as a guest.
Michael, thank you, Steve. Thanks so much.
If you like what you heard, please follow us on Apple, Spotify, or your favorite podcast platform so you can catch up with all our great interviews, like our discussion with Target SVP Nancy King on their innovative approach to harmonized retail. New episodes will show up each and every week, and be sure and tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, producer and co-host of the Conversation with Commerce Next podcast, the Voice of Retail podcast, keynote speaker, and host of the all-new Last Request Barbecue cooking show on YouTube. You can learn even more about me on LinkedIn or meleblanc.co. Safe travels, everyone.